The UK mortgage process has 7 distinct stages: inquiry, discovery call, documents, research, submission, underwriting, offer to completion. That is the whole journey, end to end, from the first phone call to the keys landing in someone's hand. Now in this video, we're going to be walking through every one of those stages so that by the time we're done, you'll know exactly what happens at each of those stages, who does what, how long each bit is going to take, and where the applications usually get declined. But here's the bit that nobody else is going to tell you and explain in the mortgage process, but I'm going to do it. And it's the bit you need to know up front. There is one rule that decides whether a mortgage case lives or dies, and almost every decline usually comes back to it. You do not run any research until you have every single client documentation in your hand. That's it. You skip that and the rest of the process can collapse. Hold the line and your decline rate is going to halve. Now we're going to walk through the whole process, and along the way I'll show you exactly where the rule applies and the 2 specific reasons applications get declined that rules like this prevent. So let's jump into it. So stage 1 is the inquiry. A client comes to you, could be a phone call, could be a web form, a referral from an estate agent, somebody finding you through content. It could be a recommendation from a friend. It really doesn't matter where they came from, to be honest. What matters is what you do with it. The inquiry isn't the start of the relationship, it's the start of the qualification. A short call, maybe 5 to 10 minutes, you find out what they're trying to do, when they're trying to do it, and what the kind of case roughly looks like, whether they're already speaking to another advisor, and if it's even possible with their expectations and if it's realistic at all. If it's a fit, you book them in for a proper discovery call. If it isn't, you tell them straight and you point them somewhere helpful. This stage exists to protect the most valuable thing you've got, which is your attention. The brokers who try to win every inquiry are the brokers who waste their first years on cases that will never go anywhere and they're never going to complete. Qualify hard here and the rest of the process is going to get a lot easier. Stage 2 then is the discovery call. Now, the proper opening of the case is this. You're looking at kind of 45 minutes to an hour. It should be structured, properly scripted, either in your head or on paper if it has to be. This is the call where the broker frames how they work, what the process looks like, how long things will take, what the client is going to need to send across, what working with this broker actually involves, and protection should be introduced here, not at the end, not as an afterthought. This is also where that rule gets set. The broker tells the client clearly no research is going to happen until every document is in their hands, politely, professionally, but firmly, because everything that follows depends purely on that. Now, by the end of the discovery call, the broker knows enough to qualify the case properly. Now, the rule that matters most before we go into stage 3, which is where this kind of rule lives, is you need to hear it clearly before the rest of the video. Do not start mortgage research until every single client document is in your hand. I've said it so many times. Not most of them, not the important ones, not we'll start and wait for the last few. All of them: bank statements, pay slips, tax returns, SA 302s if self-employed, ID, proof of address, credit reports, existing mortgage statements if they're remortgaging, anything else relevant, the whole pack in your hand before you touch sourcing systems. Here's why this rule decides everything and why mortgage applications actually get declined. When you watch mortgage cases die, the reasons look complicated on the surface. Underwriter said no, affordability didn't stack up, lender pulled the offer, property value down, 100 different versions of the case fell over. But underneath almost every decline I've seen comes back to one of 2 things. Both of them get fixed at the document stage. Both of them are completely avoidable. Reason 1 is clients aren't always honest. I don't mean that maliciously. Most of the time, they're not lying to deceive anybody. They're lying optimistically. They forgot about old defaults. They round their income up. They underestimate their outgoings. They tell the broker they earned 55 grand because that was their best year. Their actual P60 says 48. They say they've got no other commitments and the credit report shows that they've got 3 credit cards near the limit. They genuinely forgot about the missed payments from 3 years ago. Almost none of those, by the way, is malicious at all. Most of it is just selective memory, if I'm really honest with you. But if you research a lender based on what the client has said rather than what the documents prove, the case is dead before the underwriter even touches it. A credit report alone, run early, will tell you 90% of what the client forgot to mention. Run it before any research happens. Always. Reason number 2 is brokers don't do their research properly. This is the self-inflicted one. New brokers open a sourcing system. They see the cheapest lender at the top. They pick it, they recommend it, they submit it, and they haven't read the criteria at all. They haven't checked whether this lender accepts this type of income, this type of property, this type of credit history, this loan to value. They've just picked the cheapest rate and they've just prayed and hoped it worked. You can't research properly without the documents. Without them, you are just guessing. With them, though, you're advising. 2 different jobs, 2 different decline rates. If you're a new broker and your decline rate is high, the problem isn't bad luck. It isn't difficult clients. It's that you're researching before you've got the full picture. Every time you do that, you are betting your case on optimistic memory. Stop doing that. The fix isn't more knowledge, it's just more discipline. Stage 3 then is the documents, the discipline that saves the career that I spoke about. The discovery call is done. The client has been told what to send. Now the broker waits and keeps waiting until the pack is complete. Bank statements, payslips, tax returns, ID, proof of address, all the stuff I've said, all of it in the broker's inbox or in a CRM. If the client pushes the broker to get started before they've sent across the documents, the answer is no. The line is simple. I can't recommend a lender until I've seen a full picture. Get the documents over and I'll have your recommendation within 24 hours. The fear that most new brokers have is that the client will go somewhere else if they don't start straight away. They won't. They came to you for a reason. They'll respect the structure. They'll send you the documents. The brokers who panic and start researching with half a picture are the brokers chasing declines for the next 3 weeks. The ones who hold the line, though, are the ones who become known for never having cases fall over. This stage is the make or break of the whole process. Everything downstream depends on it. So then what documents do clients actually need for a mortgage? Well, quick search answer, because this is what comes up a lot. A standard residential mortgage application in the UK typically requires the following from each applicant: 3 months bank statements, 3 months pay slips if employed, P60 from the last tax year, 2 or 3 years of tax returns and SA302s if self-employed, photo ID, passport or driving license, proof of address, utility bill, council tax statement, credit report. Many brokers run their own through Experian. Equifax Check My File is a big one, plus anything case specific. So deposit source evidence, gift letter if any deposit is being gifted, existing mortgage statement if being remortgaged, tenancy agreement if it's a buy to let. That's the standard pack. More complex cases need more. The principle holds either way though. Every single document in the broker's hand before the research begins. Stage 4 then is research and sourcing. Documents are in, credit report is run, the broker has cross-referenced what the client said against what the documents actually show. Most UK brokers use something like 27 Tech or Mortgage Brain to compare mortgage products across the lender market. They filter based on what the documents show, the real income, the real credit profile, the real commitments, not what the client said. The system returns a list of products. The cheapest is rarely the right answer, by the way. Lenders have quirks. Some are slow, some are strict and self-employed, some won't lend on flats above shops. Some cap at 85% loan to value on new builds, some accept defaults over 3 years old, some don't. This is where broker experience compounds, and knowing which lender will actually take the case, not which one looks the cheapest, is the real skill of this job. Once the right product is chosen, the broker writes up the recommendation and they bring it back to the client for the next stage. Now, stage 5 is the submission. This is the highest leverage hour in the entire case. The broker presents the mortgage recommendation, presents the protection recommendation too, and then they close the protection. Then and only then will they submit the mortgage package. The order matters. Protection closed before submission, never after. Once the application is in, the client has got what they came for, and the protection conversation becomes an afterthought that they will defer forever. Application then goes in through the lender's broker portal. Income evidence is uploaded, bank statements, credit reports, property details, ID, deposit evidence, all that stuff. Everything the underwriter needs to get going. Packaged clearly, so they've got no excuse to come back with you with queries. Clients massively underestimate this part. They think submitting an application is just paperwork, and it isn't, all right? The way a case is packaged at submission decides how the underwriter sees it. A well-packaged case lands clean, a messy one gets queried back and forth in about 48 hours, and the timeline goes backwards, and it becomes a real pain. Stage 6 is underwriting. Now, the underwriter is the lender's gatekeeper. Their job is to look at the case and decide whether the lender is comfortable putting their money behind it. They check the income evidence against what was submitted. They run their own affordability calculations using the lender's specific affordability model, which is often stricter than the broker's sourcing system. They commission a property valuation. They check the credit profile in detail. They verify the loan to value. They check the deposit source, particularly looking for money laundering risks as well. And they verify whether the client meets the lender's specific criteria for the product they applied for. So what does a mortgage underwriter actually check? Well, in practice, income evidence, affordability, credit, property valuation, deposit source, ID, and lender-specific criteria. Each lender has their own quirks within that list. But the broker's job during this window is to manage the relationship. If the underwriter has a query, the broker handles it. If they want extra documentations, the broker sorts it without bothering the client unless they absolutely have to. A great broker handles 17 tiny little things behind the scenes that the client never has to see. That invisibility is exactly what they're paying for. How long then does mortgage approvals take? Anywhere from like a few days to a few weeks, depending on the lender, complexity, time of year, and how cleanly the case was packaged. A clean residential case with a fast mainstream lender can move through submission to offer in about 5 to 10 working days. Very, very quick. A complex self-employed case with a specific specialist lender can take about 3 to 4 weeks. But buy to let through limited company as well, that could take longer. Adverse credit cases could take even longer still. The single biggest factor in how fast a case completes isn't the lender, it's how well the broker actually packaged it. Clean packaging at submission saves weeks at underwriting. Sloppy packaging adds weeks. Stage 7 then is the offer to completion. Now, the mortgage offer comes through. Clients now think this is the finish line, but it isn't. The case now has to move to solicitors for legal completion side. Local searches, environmental searches, water and drainage searches, inquiries between the buyer and the seller solicitors, contract reviews, exchange of contracts, and finally then completion. This stage can typically take 2 to 12 weeks depending on the chain, and a first-time buyer with no chain can complete much, much faster within a matter of weeks. But a complex chain with multiple parties can drag on for months and months. Most brokers are quiet at this stage. They shouldn't. This is where great brokers separate themselves from average ones. They stay in the loop, they check in with the client, and they manage conversations between the lender and the solicitor when things slow down. They make sure any lender-imposed conditions are met before completion. They handle the protection going on risk at the right time. They're the calm voice in the client's inbox when the chain is wobbling. When the completion lands and the client gets the keys, that's the buzz. But the relationship still is not over. It's just starting because the broker logs the completion, sets a remortgage reminder for 2 to 5 years' time, and starts the long-term relationship that pays them for the next decade through remortgages and referrals. If you've watched all of that, the question of what does a mortgage broker actually do has its answer. The broker is the only person who runs the case end to end. The lender only sees their bit, the solicitor only sees their bit, the estate agent only sees their bit, and the client doesn't have the knowledge or the contacts to handle any of it. But the broker is the spine of the whole process. They qualify the client, they frame the work, they gather the documents, they run the research, they recommend the right lender, they package the application, they manage the underwriter, they handle the offer to completion gap, and they stay in the relationship afterwards. That's why brokers get paid. Not for trying to source something on the system, but for running the case from the first call to keys in hand without the client ever feeling lost. So then how do brokers manage this application timeline? Well, the honest answer is through systems, not effort. Modern brokers use CRM systems, things like Smart 365, Acre, One Mortgage System, to keep every active case visible, every deadline tracked, every document chased before it becomes urgent. The CRM is what stops 20 active cases turning into pure chaos. But the brokers who survive the volume aren't working harder than the ones who don't. They've just got smarter systems doing the chasing for them, freeing them up to focus on the bits that they can do, the calls, the advice, the relationships. So now you've got the process, the 7 stages, the rule that decides everything, and the 2 reasons new brokers can't understand why their case keeps declining. Then the thing this video doesn't show you is how the whole day actually runs around all of this. When the research happens, when the discovery call happens, when the admin gets done, what the actual rhythm of a working broker's morning and afternoon looks like. Now the next video to watch then is right here on screen, which is a day in the life of a mortgage broker, which is an honest version talking about what I did when I was a mortgage broker. I'd recommend you check it out.